Good morning. This is Michael DeVille coming to you from beautiful Phoenix, Arizona. Heather and I are in the West USA studios, and this is another Creating Real Estate Wealth live webinar, and it is for you. For the last 4 or 5 weeks, we have been bringing topics on how you can create a real estate money machine and become financially free. Now, we've been bringing different topics and different areas that you can maybe, this is something that you want to do, that you find that this is desirable. I'd like to do this sub-market. Today, we're going to be talking about private placement offerings. That's PPO. Now, you may ask, why are we doing this? Well, for one, it's my give back to you. This is what I get to do. I get to give back to you and hopefully improve your life. But there's this startling statistic that 100 million Americans have absolutely nothing in their retirement accounts. And this is a way for us to try and reach that marketplace and improve someone's life, give them a possibility that they can become whatever they want. And they too can get on a strategy and change their lives. So we're going to be talking about the doctrine of enough next week. And the reason we have the doctrine enough, because these strategies work. These work very, very well. And if you follow them, you are going to be successful. And we want to talk about what happens when you've become successful and you've earned this extra money and you have this income coming in. What do you do with your life? And we're going to talk about that next week. It's one of my very, very favorite topics. But today, we're talking about PPO, private placement offerings. Now, we often get this question because even though we have them within our industry, you can have private placement offerings in almost any asset class. In the real estate business, we often have them in developments. We have them in apartment complexes, office complexes, virtually anywhere where you need a private placement, where you can need a pool of capital. So what exactly is a private placement offering? What is a qualified investor? How does this affect my residential rental portfolio? Because oftentimes we suggest this as a portion of your investments, not all your investments. And how involved do I, as a real estate investor, am I in this process? So we want to talk, these are all very, very good questions. So what exactly is a private placement offering? Well, a private placement offering is nothing more than a pool of capital. It's a way of a general partner bringing the ability for other investors to invest with him and providing the capital necessary rather than going to a mortgage or a lender. This is a way that he can offer this to other investors. Now, oftentimes you're going to see in a private placement, you're going to see an awful lot of banks, mutual funds, insurance companies. A lot of insurance companies and a lot of pension funds are qualified investors. This allows them to pool that capital and return, they get a cash flow. Now, insurance companies and pension funds have what they call a burn rate. A burn rate is nothing more than the fact that they are typically using 4 to 5% of their capital each and every year. They have a burn rate because they have people that are taking money from their funds instead of increasing the funds. Now we're getting to the point where you have baby boomers like me that are actually taking money out of their funds, and they need to replace these funds. They need to have a cash flow. And we are in a LERP or a NERP world. Now, a NERP is a negative interest rate policy. That's almost impossible to find any kind of cash flow. This is just in Europe. There's just a lot of negative bonds, a lot of negative rates. And of course, you get no cash flow. You get no income coming in. And here in America, we're in a LERP, which is a low interest rate policy. We're in a market here in February of 2021 where the 10-year Treasury is around 1.2%. Well, 1.2%, you can't get much cash flow. And these private placement offerings, although they have a little risk, you do get between 6 and 8% cash flow that's typically paid quarterly. Nothing says it can't be paid monthly. Nothing says it can't be paid annually or semi-annually, but typically it's quarterly. And that oftentimes is a negotiated rate, and it will be on your disclosure statement from the private placement offering itself. And it's going to tell you whether or not this is good for you. So they're going to disclose everything that the investor and the general is looking to do. They have a time frame on it. They're going to tell you what your compensation package is. And in today, when we're talking about 2021, we're probably looking more towards 5, maybe 6% in cash flow rather than higher than 8%, although could be 8%, but that again depends on the risk that the investors are taking. So what exactly, when we talk about investors, what exactly is a qualified investor? Well, as a rule of thumb, they say a qualified investor is someone who has $1 million in assets outside of their personal residence. And the reason they use this $1 million is that you've been able to accumulate assets upwards to $1 million, which then says that you now are an astute investor because you understand the business acumen and you understand the risk, and you're able to go ahead and make a decision on your own as to whether or not this is a good enough investment for you, if this is a suitable investment for yourself. Now, the exception to the rule would be depending on the sophistication of the buyer or the investor. Oftentimes, if they work within that industry, and I'll use this example, if they're building a apartment complex, and when an investor knows the apartment industry inside and out, they know how to build them, they know how to develop them, they know how to fill them, they know how to market them, they have been involved in management, that would make them a knowledgeable and experienced investor, and oftentimes able to get an exception to the rule and still invest without having $1 million. And of course, the $1 million is really just an arbitrary figure. If we're going to do a huge project where a pension fund is going to put $100 million out, typically they're going to raise the qualifications on that because they don't want 100 people looking for $100 million. They want to get 1 or 2 investors that are going to put up $100 million. And this is just a way of qualifying who it is that you want to be involved with as a general. So how would this affect your rental portfolio? Again, we say that you could use a portion of your investable dollars into a PPO. It will allow you to go ahead and diversify into other asset classes or within the same asset class. You know, we do a lot of single family homes because we find them very, very conservative, but maybe you want to raise your risk parameter and get into apartments or offices, or you want to get into retail, or you want to do some land development, or you want to be involved in construction. Maybe you want to be involved in building a custom home. And these are often vehicles that private placement offerings allow you to do, is that you can get involved on a very limited way. It also shelters your risk. So if you're getting into an asset class that you are not very, very familiar with, you don't want to make any mistakes, so you're putting your funds with someone else who is very experienced, who is very knowledgeable of what their asset class. And if you put $100,000 up, you're typically, or actually you are limited to that exposure. So if the investment if you had an awful experience and the investment went bad, your liability would be limited to the $100,000 funds that you've exposed yourself to. And that is, of course, something that's happening in today's marketplace because we're seeing office buildings and retail projects are in trouble. Maybe you got involved in a mall back in the Midwest somewhere, and the mall is in trouble. Well, your exposure would be limited to the amount of money that you put into the project, which is why we say to you that you want to limit your risk, and this is only a limited exposure for most investors, is to just put a small amount of their holdings into a private placement offering. This is typically not something that you put all your money in. Now, how involved is the investor in the process? They're typically not involved at all. This is a completely passive investment. Now, we talk about passive investment for our portfolios because we want you to have a property manager. We want the property manager to do the day-to-day management of your investments. We want them to be the front for you. We want them to interact with all of the vendors and all the tenants and all the day-to-day problems and allow you to go dive on the barrier reef and to go ski in Colorado because you're not involved. However, typically your property manager, if there's any kind of issues, they're going to say to you, I would like to get your opinion. And before they spend a lot of your money, they're going to call you so that you are involved and you can make that final decision because it is yours. It is titled in your name. You control the property. You can sell it if you want to. Now, this is one of the downsides when you're talking about a private placement offering is that these are pretty illiquid. So if you look at their prospectus and their disclosures and they say this is going to be a 3-year project or a 5-year project or a 10-year project, if you need money inside of those time frames, you're going to find it's very difficult to get your money out. If you had $100,000 and you find that you'd like to get that money out, but we're looking for a 3-year hold period, we're going to be looking at the fact that you probably will not be able to get your money back. And if you do get your money back, you're going to have to do it at a discount, probably to the general to do so. That's why we say a portion of your investable funds into these projects. Now, they can be very, very lucrative. So a good general partner is absolutely, positively so incredibly valuable. If you find someone that has a track record of success, you want to stay with them. They are very, very difficult to work with because the prior investors roll over from one project into the next project into the next project, and the pool of investors is generally fairly closed. That's how you know if you've got a really, really good general partner is based on how difficult it is to do business with them because you are totally passive. Now, why would you want to do this? Well, you get cash flow. Probably today, probably closer to 5 or 6% cash flow, but you also get a portion of the profits. So you also get maybe between 30 and 40% of the profits that this project generates when it gets sold, because we are going to have definite time frames. Maybe we're going to build an apartment complex. We're anticipating a 3-year hold period. We're going to go from raw land to construction to filling in the apartments, getting the project completely and 100% occupied, and then we're going to sell the project. Now, that project should have profits to it, and you would be entitled to not only the cash flow that's been generated along the way, but also the fact that you're going to get 30 to 40% bonus. And then that project's over with, you get your cash, but probably they're going to sell that project to another PPO. And oftentimes you're going to find that lots of times those investors are going to roll over into the new one. That is a very, very good property manager and management company. And of course, this can be done in almost any asset class. You really have to know what you're doing. We're more than happy here to sit down with you and discuss these with you to see how suitable they are for you, to review some of the disclosures with us. That is what we'd be more than happy to do. That's our give back to you. So next week, we're going to talk about the doctrine of enough, because I'm going to tell you that these topics that we're bringing to you, the strategies that we're going to do, we have used these work. You're going to find that you're going to do very, very well with them. You're going to earn income. You're going to earn capital gains, and you're going to become financially free. And we're going to talk about the doctrine enough, because what does that financially free mean to you? And that's next week. That's one of my very, very favorite topics. Now, if you want to get hold of us, you are welcome to email us at creatingwealth@westusa.com. My new book is about to be published. That's Real Estate Investing for Beginners. That will be out very soon. If you want to get onto a waiting list for that, that'll be coming out email us at creatingwealth@westusa.com. We also have classes coming up. We have the seminar, Real Estate Investing for Beginners, coming up, and you're welcome to get on the waiting list for that. Email us at creatingwealth@westusa.com. If you would like to reach me and sit down and we can brainstorm as to how this is going to work for you, if you've got a project, if you have an investment, if you want us to sit down and maybe go over something with you, you are welcome to reach me at michael@michaeldeville.com or call at the corporate office 602-942-4200. If you'd like to get this flyer to send out to your investors and your clients, email us at creatingwealth@westusa.com. How easy is that? Now, Heather is going to do a YouTube video. If you'd like to send it out to your clients, we'd love you to do that. And when you view it for our marketing and to help us, if you would like and share it, that would just help us so terribly, terribly much. I want to thank you so very, very much for listening to me today. If I can help in any way, you're welcome to. And I want to wish you the very, very best. Bye-bye now.